Whenever you take a trade, you should be looking to profit from certain market behavior, a reaction to a level, market momentum, a breakout, or trailing your stop looking for bigger gains. Prices set the limits of our risk and our potential profits, but at what point does the market behavior no longer fit with what you hope to see if the trade still has the potential to be a winner? At what point does the trade become invalid, regardless of what price the market is trading at? And is it time to anticipate an exit from the market? And if the market is not doing what your trade theory anticipated, how long do you hold on to the position before you bail out? Knowing when to exit your trade when the adverse price action begins to eat your profits is vital for your bottom line. So let's take a situation where you've sold the market based on potential downside momentum, which you expected to come into play with the break of a key support level. However, although the market hasn't taken you out yet, and it doesn't even look like it's going to do that, trading has gone flat and the expected momentum is nowhere to be seen. So what's your next move going to be? Are you going to sit there and wait for something to happen? Or are you going to decide to get out of the position as the original premise for the trade's no longer valid? You've seen this sort of situation before. Sometimes you get out early, only to see the train leave without you. And other times you refuse to miss the trading opportunity and you end up paying for it. You need to give the trade some room to breathe, but how long is too long to stick with a trade which is not acting as you hoped? The issue is that the length of time in a trade for your strategy might have an impact on the win-loss ratio, or it may not have any bearing at all. It could be that there are telltale signs that a trade is not going to work, which are independent of time, or it could be that time is the most all-important factor. So it's a good idea to backtest your strategy to see whether there is any correlation at all. And if you have the data for trades that you've already taken, study that as well. And if there's no correlation, you can feel confident in sitting your trade for as long as it takes to take you out for a win or a loss. But if there is, then it's definitely worth your while to take this into consideration. Of course, it could be the case that for what you consider to be a long time to be in a trade, there are too few trades to draw any reliable conclusions from. Identifying whether there are any triggers which make trades less likely to be winners is slightly more involved, but it's well worth your while. An indicator, or maybe a certain type of bar, might give you an early warning. If you test the occurrence of this for both your winning and your losing trades, and it reveals itself to be a reliable signal, well, then you have something to work with. If you do find that there's some sort of signal indicating that an early exit might be sensible, there are some clear reasons to do so apart from the obvious. From a psychological perspective, you can start getting into bad habits that will affect your trading success going forward. You could end up sticking with the trade taking a winner, but for the wrong reasons. It might have been better to exit the trades you have, but because a new setup in the same direction then occurs, you get away with it. This can reinforce staying in trades too long when your data suggests it's bad to do. If you take a loser when you've been starting to feel uneasy about the trade, it wouldn't be unusual to beat yourself up over it. But I'm of the opinion that the biggest potential issue is that while you're clinging to a trade that's going nowhere, there might be another, better opportunity, which you end up missing in either direction. And if you've taken responsibility for the situation and you've done the research, you can relax in the knowledge that you are being proactive in your decision-making, whatever the outcome of any individual trade. Remember that wins and losses, they come in a random distribution. And there's more to it than just identifying that the trade might not work. If you have some sort of signal, time or otherwise, then how are you going to exit? Will you simply use a market exit? Will you tighten your stop to a closer reference point? Will you alter your position sizing to take into account the additional risk and also give yourself the opportunity to re-add to the position if the situation changes? Timing in trading is not simply about knowing when to take a position, but it's also knowing when it's right to exit as well. Getting out of a position can often be more subtle than always taking a winner to target or a loser to stop. Reading the market's intentions by its behavior can alert you to change before price moves, allowing you to make proactive decisions in the correct circumstances. Now, let's imagine for a moment that you take two types of trade entries. You take pullbacks and breakouts. Knowing what to look for to get you out before your stop loss can get hit can save you a full 1 hour loss because the setup pattern is no longer valid. So if I trade pullbacks, I need to see an impulse leg that shows market intent. When price pulls back, this is the opportunity to enter, but what happens next is just as important. The bars in this graphic have pushed up, showing some momentum to the upside. A lazy pullback happens with a standard reversal type of candlestick, and a buy stop is placed above the high. What we would now expect if we are looking for continued momentum to the upside is price to begin staging a move. At A, instead of price heading to the upside, we see price form a trading range. Well, this is not something we want to see considering we're playing for another impulse move to the upside. And this may be a point where you just tighten your stop or you take all risk out of the market via an exit. And B, in this section, assume that price continued to the upside after the buy stop order was triggered. We get a nice push up, a reversal candlestick forms, and price slams hard against us. This is not conducive to another impulse leg, and the wise choice is probably to exit the trade. So for your homework, I want you to consider breakout trades and what helps build the case for a sustained breakout and price moving in your direction. In other words, what should the resolution of a breakout look like to be successful? Next up is do the opposite. What would a breakout that has the potential to fail look like? And by doing this type of work, you can save yourself from taking full stop outs because you know what you're looking for with a successful pattern resolution.